Earnings growth and future earnings potential are arguably the most influential factors on a company's share price. When companies release their annual reports, they will include their EPS and how it compares to previous years. Share prices can often move sharply up or down immediately after a company announces its results, as investors quickly decipher them. But what exactly is earnings per share? Earnings per share or EPS is an important financial measure that indicates the profitability of a company. It's calculated by dividing the company's net income and its total number of outstanding shares. It's a tool that investors use frequently to get an understanding of the profitability of a company before buying its shares. You might notice that not all companies will have a value for their EPS. If the company is not yet profitable, then it will have a zero or negative EPS. This often just means that the company is in growth stages and therefore is focusing on maximizing revenue over profits. Ideally, a company will be growing its EPS alongside rising revenue and profit each year, which should cause its share price to rise over time. However, whether the EPS has been growing or falling, make sure that you understand the specific cause. As an example, the basic EPS calculation does not consider the capital needed to generate the earnings within the equation. If two companies report the same earnings per share, but one uses significantly less capital to bring in that income, the company is probably managing its resources better than the other. However, that fact wouldn't be reflected in a comparative analysis of the two companies' EPS. You can compare EPS with the share price of the stock to determine the value of earnings and how investors feel about future growth. As always, it's important that you don't rely on earnings per share only when making investment decisions. It is, however, a good measure to use in conjunction with other measures and financial statement analysis. What's the difference between EPS and adjusted EPS? Companies often report EPS values using net income numbers that are adjusted for one time profits and expenses, like sales of business units or losses from natural disasters. While a company's adjusted EPS can be a more accurate indicator of a company's performance, some companies aggressively adjust their net incomes in misleading or even fraudulent ways to boost their adjusted EPS numbers. So always try to find the figures that are being used to return the EPS you're looking at, or do your own calculations. So, what is a good EPS? What makes a good EPS is determined less by the absolute value of the EPS and more by its year over year change. The absolute value of a company's EPS should increase annually, but the rate of increase of EPS should also accelerate. A company's EPS can vary based on fluctuations in earnings, total number of shares outstanding, or both. A company can boost its EPS by increasing its earnings or reducing its share count through a share buyback. But a company that increases its outstanding share count faster than its earnings will cause its EPS to drop. Stock investors can further evaluate a company's EPS by considering it in conjunction with its PE ratio and determining how the company's share price is fluctuating relative to its earnings. It's a good sign if the company is able to grow its EPS each year. However, having established whether EPS has been growing or falling, try to work out the cause. Was it from normal ongoing business operations, suggesting that the company has seen a rise or fall in the market share of profit margins? Or was it a one off event such as unusually large expenses or cost cutting, which might have caused an anomaly? Again, ideally, a company will be growing its EPS alongside rising revenue and profit each year, which should cause its share price to rise over time. What are some of the limitations of the EPS calculation? In isolation, EPS doesn't mean a great deal and should be treated as just one component of your analysis. There are also reasons why a rise or fall in EPS can be somewhat misleading. For example, as we just mentioned, if a company buys back some of its own shares, then there will be less ordinary shares on issue and therefore more earnings will be attributed to each, even though profit could have shrunk. On the other hand, while falling EPS is generally a negative caused by higher costs or lower revenue, it could have been influenced by something like a stock split, for example. A company's EPS could also be positively or adversely affected by economic factors that are beyond its control and also impacting other companies. Bottom line, do your research.